listening to the Crude Audacity Podcast, the podcast that talks shop, shit, and strategy for oil, energy, and politics. Here's your host, Catherine Mills.
Good morning, everyone. Thanks so much for tuning in. You are listening to the Crude Audacity Podcast, the podcast that talks shop, shit, and all things strategy for oil, energy, and politics. Today's show is going to be loaded because returning for their second time on the Crude Audacity are Matt Marshall and Rob Via of Aegis Hedging Solutions. Welcome back, guys. How are you doing today?
Doing well,
Very
Catherine.
well, thank you.
How are you?
Doing well. I'm so excited to be sitting down with you guys again. Y'all are my go-to for what is happening across the market. And when we last spoke, as you know, it was BC before COVID. Now we're in COVID recovery, or some claim to be. And when we were last speaking, it was really about the black swan events that were hitting the oil and gas industry. But today we get to talk about the full spectrum. So before we jump into that, can y'all give a little background for some of our new listeners on who you are and who Aegis is and what y'all actually do for the markets or commodity markets?
Yeah, absolutely. So thanks for having us back, first off. So Aegis, we're a full service financial hedge advisor. We focus on a variety of commodities, oil, gas, NGLs, refined products, interest rates, metals, FX as well. So and what we do, kind of where we fit in, so we work with over 300, on the oil and gas side, 300 E&P entities that produce north of 7 million BOE a day, or roughly, what's that, Matt? About 25% of
25.
lower 48 production. And what we do for our clients is provide them with objective and actionable kind of insights and views on the market. In light of that, help them with their hedge strategies and tailoring that to their profile. We do all the execution work with their counterparties and do all the back office work around hedge portfolios for our clients, and kind of wrap all of that up with some cutting edge technology that we're really excited about, that we've been investing heavily in over the last few years.
That's awesome.
well
I
said.
love hearing that because, I tell everyone that if you really want to know what's happening in the world, you follow the energy markets. You see how trade is happening across countries. And so many times people forget about the geopolitical implications of the industries we deal with.
Yeah,
For sure. And across energy, metals, you have there's that the trade frictions the governments bring in all the time, and that's something we have to watch really closely. But you're so right about energy. I mean, it's even like these days, it's like up and down. You can almost track movements of oil with how we're coming out of COVID. It's
yeah, absolutely.
Yeah, well, on that note, so yesterday we saw fluctuations, and I know I gave you the quick heads up that this would be my leading question. But full disclosure for those listening, I was sitting in about 2 back-to-back meetings, and I started getting texts from friends across the oil markets, even some up in Canada saying, oh no, it's happening again. And come to find out, we are seeing a fairly significant drop in just what we know WTI to be, Brent crude. We saw the drop across everything from the mid 60s down to, it looks like, the high 50s at this point. And I haven't been able to link it back to anything specific. I'm thinking it's OPEC related or some sort of infringement upon the current agreement for production cuts. So I kind of wanted to get y'all's take on what might be causing this jump, or this current jump.
Yeah,
Matt
you bet.
hasn't talked about OPEC at all here recently, so we'll see what he can pull out of his hat.
how about I pull up a WTI price chart, and we can kind of talk from there. And because this chart,
Look at
you can
that
see a lot of
beautiful
history.
negative. Look at that drop.
We
That's
cut
so
it off.
pretty.
Yeah, we cut it off at $10.
I just didn't want to look at it. Yeah, but you can see a lot of history. I mean, there's that day. What was it? It was the day before the May contract expired, and that was the negative day. And out of that, the market was trying to rebalance itself by telling producers to cut off and trying to encourage demand and trying to keep oil out of storage. And in that period of time right here, you can see different parts of the forward curve where that's the prompt month. So that rolls forward every month. And then you have different other strips that are the rest of 21, Cal 22, that's the calendar year 22 and 23. And your near-term prices during this period were a lot cheaper than the later term prices. And we call that contango, that upward slope. And it's a signal that there is so much supply in the spot market or the near-term market that prices get sold down. Well, contrast that with what's happened since the 1st of January. And that's where the shape of that forward curve is completely the opposite. It's backwardated. It's where the near-term prices are expensive and the longer-term prices are cheaper. And when you see that, it's a telltale sign that in that spot market, or really that prompt market, which is the next month, the bid is so strong and people are trying to bid up price so high so that they will pull oil out of storage to be able to serve what is growing demand. And so that's a healthy market. Now, producers don't like it, because what that means is if you're trying to hedge right now, the near-term price is, what headline do we always see right now? You see 59, if you look at CNBC or something like that. But if you're trying to think about planning for 2022 or 2023, you're staring at like 56 and 54. Right. And that's a struggle. So here's what I would say about like recent price action. I mean, you can see the front of the market came off, but look at this. This is really interesting. So Cal 23 in the blue really hasn't changed much. It changed much since mid-February. Yeah, so you've got this back of the curve that's anchored, that is probably more of, let's call it a more stable, longer term outlook. I don't believe forward curves are good forecasts, but this is, if you do believe that it's a good forecast, it's basically telling you that, hey, mid-50s long term is where the market's comfortable right now.
And there's a lot of money to still be made in the mid-50s. There's a lot of investment opportunity. There's a lot of investment opportunity in terms of new money instead of the traditional routes. But one thing I have been hearing, and Rob, I mean, you kind of are tuned into the airwaves that are the oil and gas social sphere, is that our oil prices are, even our gas prices, well, I mean, I looked at gas earlier today, so I would argue this one, but they are artificially enhanced. We still have a glut. We are not consuming as fast as we were BC before COVID. Although demand is rising, it's not rising in the predicted V-shaped curve that we all know, love, and hoped for. So when you hear we are artificially inflated still, what are your thoughts about that? Have you been hearing that out on the streets, so to speak?
I mean, so I've got a few thoughts on that, but Matt, what are your thoughts on the artificially inflated piece? And then I've got a few things to share on kind of the price area where we're in, and how different perspectives have kind of looked on that. But
sure, yeah. If I heard somebody say artificially inflated oil price, the first place I would go to that is like what has been supporting oil price, and And you can make that argument that OPEC holding back, let's call it 7 million barrels a day of production, maybe it's 8. That could be considered artificial, because the market, it isn't supply and demand that's setting that. It's maybe more like massaging price a little bit, trying to see, you got a cartel trying to keep things in order. But there are some good things going on that are in despite whatever OPEC is doing, there are good signs underneath all the data. And one of those is inventories. And, inventories are a good gauge of just how much supply is out there. I mean, what are your sources of supply right now? If you need oil, you could either, you get it straight from, the well down through the pipeline, you get it through that way. So that's kind of like everyday ongoing stream. Or if you need it, you pull it out of storage. And like I was talking about, that forward curve, it was backwardated, it was downward sloping. Mm-hmm. That was a sign that oil's trying to come out of storage. And if you look at some history here, we've got two different things. You got EIA's data here on the left, over here, and then we've got some OPEC estimates over here, and you can see inventory starting to come down starting late summer through the end of the year per EIA, and we're looking at the same stuff. This is OECD countries, so it's mostly the Western developed economies, doesn't include China, so that's one of the downsides of using this data. But you can see those inventories coming off pretty quickly, not as quickly as they went up, but coming off pretty quickly. And then you can see per OPEC's forecast, they've got these inventories still coming down through July, and even with the production increases that they announced earlier, at the end, was it 2 weeks ago now, or a week ago now? Even with those increases, they still expect inventories to drop. So, I mean, there's good things going on in this market. It's cleaning itself up. Demand's coming back, and I've got other stuff to show you on that. But yeah, we have to be very concerned about the choices that OPEC makes through the end of this year. And then 2022 is a different story, but we can talk about that. So yeah, some good things going on underneath the surface.
Well,
But
that's good
you
to
know,
hear. We definitely are going to have to talk about the impending 2022 because, like you said, that is
Yeah.
kind of there's a different narrative. But Rob, what were you going to say about when you hear coming from clients or those looking to get an industry that we are artificially and increasing price for whatever reason? Hey guys, what do you think about Matt and Rob so far? They're pretty great, right? They are most definitely my go-to guys for what is happening across the market, and they're always so willing to share their insights, which is why I want to tell you a little bit more about Aegis Hedging Solutions. Now, Aegis enables companies to manage their commodity price and interest rate risk through proprietary capabilities. Aegis provides unique insights into commodity and rate markets. They develop and execute cash flow protection strategies, something we all need, and they manage all hedging activities through a SaaS technology platform. And if that wasn't enough, for the fourth year in a row, Aegis has been named the leading hedge advisor. That's huge. While they may be headquartered out of the Woodlands, Texas, they have offices all over. And you know Denver is my favorite office. But to learn more, be sure to look down in the show notes where I have Matt and Rob's LinkedIn profiles linked, as well as visit www.aegis-hedging.com. That's AEGIS-hedging.com. I know their team will be able to help you out in more ways than one. Check them out today. And in the meantime, let's get back to the interview.
yeah. So yeah, I mean, I think that there's some of the narrative. A lot of folks here coming out of kind of the public space is living within cash flow and keeping things kind of tight and really not putting much capex back into the ground. But where I think that, and again, this is kind of one of the things where I think the size of our client base gives us a unique perspective. Some of the things that we're seeing is that, and just what I'm hearing from folks that are, whether that's looking for kind of PDP buys and liking the price environment that we're in now, or more specifically, some of those private companies that are looking at this price environment and saying, hey, we can generate returns. This is, we can make money at these price levels.
Yep.
I think that is somewhat under the radar and not what a lot of people are kind of thinking that, there could be, there's some big private players out there that, think that this is an attractive price environment and, maybe looking at putting some dollars back in the ground, picking up some rigs and bringing some supply back on.
That's so true.
That. It's kind of funny though, because you heard when we were mid-COVID, because remember BC mid-COVID, now we're AC, AD, I don't know what it is anymore. But New York, there were claims that Wall Street was no longer investing in oil. I actually know a number of companies who divested their retirement funds for employees to get away from energy. So it's kind of interesting that you're saying that the average Joe is recognizing opportunity in this price environment, whereas some of the big players might still be hesitant.
Well, and I think some of that may differ also just from Wall Street versus private investment, right? I mean, there's still private capital out there that, and depending on where they are, they may be a little quieter about their energy investments, just given kind of the state of I see you shake your head there, Catherine. I agree with that, but that may be a little more quiet about that, but are still seeing opportunity out there, right? And I think that's just some of that has been a little bit of a shift in some of the traditional sources of private capital. But no, I mean, people are identifying opportunities and like I say, with some of those that are established and have a footprint and are looking at their inventory and saying at this prices we can make money, but also some of the private capital that's coming in that's kind of more fund-based models and things like that, where they see really it's been more PDP buy opportunities and seeing an opportunity to kind of buy and kind of lock in at these I was about to say higher prices. Some people may have different thoughts on where prices stand, but from what we've seen, we feel is relatively attractive price point where you can lock things in, and that's where again Aegis comes in and where we can help some of these guys out where they're looking to do some long-term hedges and kind of lock in their returns off of buying kind of a discounted PDP buy.
So they're increased prices to me, given my tenure in the industry.
Right. Yeah. There's some people though that are still longing for those $100 day. I mean, who's not, right? But that's just all that they can go back to, and so that they look at $60 or so, and they're still kind of saying, that's not moving the needle for me.
Well,
Yeah,
I have
but that's also the
Go ahead.
yeah. I
Go
was gonna say that's also the natural progression of a maturing industry.
hmm
You know, the locations for the best oil are essentially known, and efficiencies get better and better, and at some point they start to plateau, and at some point there is just the proliferation of the technology among many participants, and prices come back down to marginal cost. And I think and that's just any industry, it's just the natural cycle, unless there's a reintroduction of a new technology. So what the reason that that's important to note is that as an operator right now, if you're seeking out opportunities, is that if prices start to rise above what you perceive to be above your threshold, your price threshold, your break even for for spending new capex, then guess what? Your neighbors are probably seeing the same thing. And if that's the case, then seizing the opportunity and locking in those prices is becoming more and more important, because it's possible that the margins are getting thinner and not as easy to achieve. So I think that's where hedging comes in. Is it's becoming more and more important.
Well, if anything has been taught or learned, or if anybody walks away with anything over the last 2 years, it's that fluctuations are the only constant in the energy industry. So there you go,
Yeah.
hedging, protect your assets, protect your company, protect your future. That being the case, though, this one's for Matt. Okay. Who really is Big Chief on campus when it comes to the oil and gas industry? Because I mean, we talk about them as oil and gas. They're two different markets. All right. They fluctuate,
True.
you know, I would say as inverses of each other, because that's what I've always been taught. But the talk tracks, even throughout COVID, it's not really changing. How do we improve this? How do we make this better? Where are our flaws? Where are our breakdowns? What's the view from the bus bench? The talk tracks really haven't changed. So understanding the impacts that we have from the geopolitical spectrum in terms of what happens in Russia affects West Texas, what happens up in Canada, and the loss of a pipeline affects what's happening out of Houston. I mean, it's just all so intertwined. So seeing how OPEC plus, China, all of the players are now more aggressively interacting, I would say, or at least you're seeing it more on social. Who is Big Chief on campus? Who do we really need to be paying attention to? Is Saudi still
Yeah. No, it's a very easy answer. The person running the show is the consumer. It is the petroleum consumer.
I like
And that was the story in 2020. We lost demand, and therefore supply had nowhere to put the oil. Gas was in a little different situation. Gas was in a much better situation, and we can talk about that if you like. But as demand came back, that allowed supply to come back. It allowed us to take down the these record high inventories, where we are approaching the tops at just about every location you could find in the U.S. and globally, where we put it on putting it on tankers because we didn't have anywhere else to put it, and those were full too. And that's so like that. And the recovery has been exactly that. It has been how fast can demand come back, and you can trace it back. Like the futures market very trades sometimes in expectation, and you could see it whenever the vaccines were announced that they were actually ahead of schedule and would be here months before anybody thought they would. You started to see prices escalate. And what have we seen in the last few days when you see prices retreat? On what news? Well, some of it was perhaps Iran, China, things that you mentioned there, but it was escalation of outbreaks of COVID in India, and the threat that demand may not come back as fast as what was expected. So it's the consumer. Everything else is just trying to fit in after that.
Okay, so you don't think that when we see China and Iran start breaking sanctions and start playing with each other on the sidelines, that doesn't have as big an impact as our daily consumption for Amazon Prime?
Well, it will have an effect, and it's just a matter of during what time periods it's going to have most of its effect. So, for example, right now inventory, like I don't know what Iran and China have been doing behind the scenes, but what I can say is that based on the inventory data that we have, it looks like inventories are coming down despite anything going on. And what that tells you is that at least in those OECD economies, like we were just looking at, the supply demand balance is undersupplied. I mean, if you're pulling down 90 million barrels per month, that's 3 million barrels per day that the market wants and doesn't have. So I'm not sure what's going on behind the scenes. And then the second thing is that as demand recovers, eventually OPEC's 7 million or so a million barrels a day that it has on the sidelines will be brought back into the market. If demand grows fast, then OPEC's going to run out of supply. And then the incremental growth in demand is going to have to be solved by somebody else, namely U.S. But then what happens if Iran actually does find a way to consistently cheat or to ease sanctions? Well, then it takes a longer time before that OPEC plus Iran basket of supply can satisfy global demand, and it might push price risk further down into 2022.
Yeah, that's interesting. It's where there's a will, there's a way, we've always found. But what has really been kind of playing on my mind and something I've been working to understand better are what we're seeing across natural gas, because there's obviously the environmentalist dream, green dream, as I like to call it, attack on oil, especially here in the 48. How is natural gas going to survive this? Because what did we break $3 earlier in March, and now we're back down to the epic 250 that we've just had for prolonged periods of decades.
Epic 50.
Yeah, what's sad is that 250 or so is kind of what next summer 2022 is priced to. So you've got kind of a whole curve that's suppressed right now. Natural gas is very much influenced by oil. In the sense that the two largest sources of natural gas production over the last 3 to 4 years have been the Permian Basin, its associated gas, the gas that comes from the oil wells, and then the Appalachia Basin, so the Marcellus Utica plays up there in Pennsylvania, Ohio, West Virginia, and that's more a drier gas or an NGLs rich gas. And so those have been the primary sources of all of your new supply. Well, the Permian Basin supply is still suppressed. And then let's get back to talking about your environmental effects. Appalachia is unable to grow very much anymore because it doesn't have enough pipeline capacity to leave the region and to take the gas to other demand regions that may need it. And so there's a pipeline up there that's been in development for years, and it's been now delayed several times, and it awaits a few permitting rulings. It's Mountain Valley Pipeline, and it starts right there in that liquids-rich part of the Appalachia Basin, the Marcellus Utica area, and it's tied up right now. And right now it looks like it's at the earliest, the end of this year, maybe into the middle of next year before it could get its permits and be able to put into service. So there you have environmental effects on oil that may have trickled into like how people view oil investments. And on the gas side, you have fights against pipelines to be able to bring more supply to market. And so what that means is that the Gulf Coast, where most of your demand growth is, it has the potential to be starved of natural gas here in the next call it year or two.
So that's where I need to put my money.
In those Gulf Coast players, we're seeing a lot of that. We're seeing a lot.
Yeah.
That's like.
Well, interestingly enough, on natural gas, just not investment.
This is not
interestingly, yeah, you gotta put that disclaimer in there. So, and interestingly enough, though, I think that on the natural gas side, you're seeing some kind of bringing it back to some of the capital that's entering the space, and that's more specific to natural gas. I think you're seeing some investment theory on a longer term play on natural gas, and you're seeing that through the likes of some private companies that are really going out after consolidating a lot of natural gas assets in the U.S. I mean, you've seen that in the Barnett. You've seen that in the San Juan. There have been some pretty big deals that have come out here recently. I've heard a few groups that are trying to do some things of that nature out in the Marcellus. And so, it's interesting, I think the investment theory behind that, again, it kind of comes back to buying cheap PDP. And, you talk about the back to the 250 realm and kind of, where we've lived for a while. But I think that's one of those opportunities that folks are kind of seeing that as natural gas being a little bit bigger of a player in the future. And now's a good time to kind of consolidate assets and buy low.
Yeah, and Catherine, here's how that goes down. Like stuff that we get to see behind the scenes that most people don't is that you can read the public guidance and they'll tell you, oh, I'm going to grow by this percentage, next year. I'm going to have this many rigs, this many well completions. What we get to see is the private guys. So it might be private equity, it might be a family office, or it might just be plain vanilla private company.
Yeah.
And we see is they step in and they say, hey, I have an opportunity to take interest on 4 new completions this year.
Mm-hmm.
And I'm going to do it. And then they come to us and they want to hedge basically the entire NPV of that project out through 2, 3, 4 years by hedging in those gas prices and NGLs prices sometimes. And so what we have seen is an uptick, not only in the acquisition and divestiture activity, like Rob said, but also just PUDs. It's just additional action there. Yeah, and part of that is not just because of natural gas prices, it's because of NGLs prices being pretty good right now and having a pretty good outlook.
So I was going to ask you about NGLs because as a reservoir engineer, it's always on the back of your mind. You're told to track it. You're told to do a little bit of forecasting on it. It's not really the norm, but they fluctuate in and out of power, so to speak. So what is happening in the NGL market that's sort of a result or a prelude to what's going to happen oil and gas wise?
Yeah. Hey, guess what? If this goes back to the oil market, it goes back to, we started out with oil demand and then we talked about oil production and then associated gas production. Well, I'll see guess where most of your NGL production growth has been coming the last several years. Permian Basin, Appalachian Basin, and really Permian Basin is the big one.
Yeah.
And so, they're producing, same well, producing the oil and the gas, but also ethane, propane, butane, normal butane, isobutane, natural gasoline, some other, cats and dogs of, minor NGLs.
And a partridge in a pear tree.
I can't name them that fast. Good Lord.
Hey, don't give me, I'll go on olefins. Well, you better stop me because I'll keep going down the chain.
So what I'm hearing is I need to get on board with re-becoming an Appalachian American.
I'm glad you're politically correct because some people will just use other language and we don't appreciate that. Yeah. So production of NGLs has been really suppressed, but the big thing that's happened is that despite supply being down, we've seen a rebound in international demand for LPG specifically, like propane and butane. And so a lot of the export projects that had been on the books in the US for several years now finally got done during 2020, especially toward the end of 2020. And suddenly your export volumes out of the US jumped. And frankly, our supply demand balance can't handle it. Okay. It's too much demand. And so something needs to happen. And there's some people out there who think that propane and butane prices are going to just take another step up because what they need to do is get so expensive that you can't make money exporting them. That is a point of view out there I've read several times. Our point of view, and this is not, trading advice. This is, you have to understand that like we're not saying that the future is going to perform like the past, but in the past, what has happened is, as prices go up, there's a price level, like a difference between the Mont Belvieu, which is Gulf Coast prices for propane and butane, and the Asian prices for propane and butane. And when they get too close together, you start shutting off exports. And we're still about 10 cents away from that on propane, which would mean that propane and butane have a little bit room to run if that's the way it works out. So yeah, good outlook for those guys, for those commodities.
Breaking that down, because I claim to know everything you're talking about, but sometimes I don't. For the layman, how does that affect the everyday American, not the savvy investor, the savvy market analytic?
Yeah, I hear you.
What does that mean for the average Joe out there who's consuming one way or the other, but might not realize what they're consuming?
Yeah, so the average consumer most people don't consume a lot of butane unless, you're But propane, you're probably a lot more bigger consumers out there. The bad news is that propane, the Mont Belvieu prices, like in the well, in the salt cavern in Mont Belvieu, Texas, that price can do a lot of things. You're still getting a much, much, much higher price when you go and you buy a new container at the grocery store or Costco or whatever. The price is outrageous. The retail price is just super high. So you probably won't see a big fluctuation in, say, a 10 or 20 cent rise in propane prices in Mont Belvieu. Yeah.
Okay.
So we're good to keep grilling this summer, is what you're saying.
I was about to say
you should
that. I was
always.
like, so COVID's not going to shut down the 4th of July. It's going to be propane.
Yeah, we're not quite there yet, but I would say if I were using propane to heat my home or business or to cook with going into next winter, I would make sure that my tanks are full going into October rather than waiting too late. Yeah.
So you had mentioned some of this it's not going to be the same story for the upcoming 2022. And, I know we're in April here, but in the blink of an eye, we're going to be done with 2021. As slow as 2020 was, it went fast. So what are you predicting is going to be the shift for us in these next few quarters?
Sure. I think there's a few things to watch, and one thing that we do is we've kind of put this on paper, and you're speaking about natural gas. You're just thinking about all commodities.
Just in general, I always keep my eye on the oil market, and natural gas is my second, which it sounds like I should be paying more attention to natural gas, but just the narrative itself. Everyone's kind of surviving. I like to reference my age of consolidation, but that's not what we're seeing right now going into 2022.
Okay. Yes. Here, let's just talk about commodities first and about oil. So there's been a lot of demand recovery already in road fuels and other fuels that I mentioned, like LPG. One of the categories of fuels that has been slow, and you can understand why, is aviation fuel. Jet fuel. Yeah. Because if you're not getting on an airplane, then the airplane doesn't have anywhere to go, doesn't have a need to go anywhere.
To go to Paris right now, I'm just saying, super cheap.
Yeah.
But you can see that the TSA, compared to about 2 months ago, the TSA is checking in about twice as many people per day. So it's rising fast, but still, long haul flights. Country to country flights, intercontinental flights, they're of course not back to where they were, and that's a major source of demand growth. And I think that's going to be, happen in earnest toward second half of this year and into 2022. The other thing that I'd watch out for is that the longer that the U.S. isn't investing in new oil wells, the more chance we have of having this whipsaw effect in 2022, where demand rises. OPEC can't serve the barrels. You need barrels from somebody, but there hasn't been ongoing investment in it to be able to provide it. And that's when the market could be acutely undersupplied and you could start to see prices start to escalate.
So
Matt, this question came up here today, and I'm just kind of curious to hear, so you get into a situation where there's an undersupply like that, how quickly do DUCs play into that conversation?
Yeah, and I'd have to go check the current state of DUCs, but DUCs so far, and DUCs for people who don't are outside of oil and gas.
Yeah, good call.
A DUC is not a quack.
Yeah.
So it's very bad English translated into a 3-letter acronym. It's drilled but uncompleted wells. In other words, it's a hole in the ground, but they haven't fracked it yet, and so it can't produce oil and gas. And what happens is you get an inventory of these wells if you drill a bunch of wells but you don't complete them. And we had a lot of that happen as the Permian Basin was growing. It also happened in other places like in Appalachia, but to a larger extent in the Haynesville, so like East Texas and Northern Louisiana. And so the idea there is that you can actually bring those to completion a lot faster than you would from starting a well from scratch. And what's happened this year is those DUCs have been used to support production, but not to support growth. Because you've already sunk some cost into the well, and so the incremental cost is small. As we get into 2022, I think what happens is that if the situation unfolds like I described, where there's this gap between demand growing and supply not keeping up with it, it's going to take more than ducks. It's going to take new wells, being drilled and completed. But to the extent at which, it just depends on that discrepancy between the demand and the supply.
Are ducks still playing a role in asset acquisition? Because back to your point, PDP, proved, developed, producing, is really where people were sinking their money now. Just because you had a PUD doesn't necessarily mean that you're going to get paid for it. And one of the best ways to follow the money a few years ago was to follow the duck trend. So is it?
It's a great question.
Oh, good. Yay. Okay. So go for it.
Well, so here, can I answer a question with a question? How about that?
Oh.
My question would be, if you are, if you're looking at an acquisition that has ducks, my question would be, why aren't they completed already? Because I think it's very possible that some of that duck inventory is actually not very good inventory.
Mm-hmm.
And I have no way to quantify that, but I do know anecdotally that when we counsel acquisitive firms who either have an asset that they're targeting or they're just thinking in generally, that duck conversation has not come up in my conversations yet at all.
Yeah,
and I think it's because
same goes with acreage and PUD value that's put on to PUD prove undeveloped. So drilling locations on a position that comes with a acreage footprint. I mean, wasn't that long ago that you were seeing PDP value, PUD value, acreage value going into these acquisitions, and it's largely kind of come down to discounted PDP buys and I mean, it wasn't that long ago that we were talking some big figures in the Permian. You saw some entrants going in there that were paying, for just the acreage, just the rock alone, right? And it's largely, I mean, it's been such a quick shift from where we were a few years ago on how deals were getting, valuation process. So it's been interesting to see that. I mean, and to Matt's point, I mean, we largely, when we're talking through good hedge strategies around folks that are looking at acquisitions, most of the valuation is just primarily going into PDP these days.
So that all being said, I know we've talked about this a little in the past, but the paradigm shift of how do you make money in oil and gas? And we've got a number of companies that the way they make money, or the way their business plan was to make money, was to exit, to prove up real fast and to get out. And now it seems like the long-term development strategy is actually the plan. So what's some insider trading you can give us on this paradigm shift here?
Yeah,
I mean, go ahead, Matt.
Well, I was going to say something I said earlier, so you go ahead. I'll hone it mentally while you say what you're going to say.
No, I mean, I was just my thought process, on the private side, like the traditional private equity, I think that a lot of that is looking back into kind of becoming an operating company, right? So they are largely kind of getting, I mean, not to take anything away, they've always been technical and had good technical people, but I think just trying to set themselves up to be more of a traditional operator and looking at holding on to assets for longer term. I mean, and some of that goes back to, again, the acreage values on some of these deals. I mean, you saw some of these private equity backed management teams, a few years back, that they were primarily going out and buying. They were looking more to aggregate the leasehold and aggregate acreage in hot areas, kind of maybe drill a couple wells, prove a concept, and look to flip that, getting paid on acreage, PDP, PUD value, getting some value along kind of those three streams, so to speak. And so now I think that you're looking at different forms of capital coming into the private side. Yeah, it's interesting. It's a little bit different from the mentality of the makeup of some of these teams and the also life cycle of the investment and how long they're going to be holding on to that.
Yeah.
Ding, ding, ding.
Here's yeah,
I got distracted because I thought that Matt's doorbell was about to ring with the UPS delivery there. But,
I've been waiting.
It looks
on
like
a
he's going to the
coffee
neighbor.
Amazon
So
Prime.
Amazon Prime.
Background,
Yeah.
ladies and gentlemen.
Yeah, there it is.
Bringing us out
That's
of
not
COVID.
that was not a plug or anything. It just it so happened. Matt's
unless he gets
coffee
me free
showed up.
stuff. Unless it gets me free stuff.
I'm just throwing this out here. I would love Bezos to sponsor this podcast. So, you know.
Yeah, there you go. Yeah. And he may have a little bit of money to put in.
Yeah. Here's your answer. I think when you start thinking about like how does somebody who's not in energy finance think about like how are they making decisions? There's been this change. Like you mentioned, you can't just flip acreage right now. That's not widespread what's going on. I think the game right now is creating cash machines. And it's also a matter of like measuring how much cash you need to be able to generate to satisfy an investor. And I think those conversations are happening every day. So for example, I mean, just like when you think about somebody who has a cost of capital of 20%, okay, which sounds high, but what that means is that every year you need to create free cash flow. That means cash that's left over after you pay all your bills, including your interest, that 20% of whatever equity was invested, right? Okay, so if you look at prices right now and you say, if I can get a $59 oil price, it gets me over that 20%. I think that people are quick on the trigger right now and they say, I have capital available for that, but I have to get really precise about it. And so the way that we address that is we look at it statistically. So of course, the easiest way for a hedger to come in and say, okay, well, I've got a solution for you. I want you to hedge 100% of your production. It's at $59 and like, look how smart I am, but the truth is what people do is with our guidance is to look at it statistically and to say, look at current prices, try to figure out what the, a good 25th percentile to 75th percentile range of prices is likely to be, and then put hedges in place to make sure you can clear that 20% hurdle. And I think people are getting faster to making those decisions. They're getting more precise in it too.
Yeah. And I mean, we've seen some of those too, where there have been situations where they'll look to wrap an asset, which basically means that they're going to look to, hedge a high percentage of the PDP out long term and just kind of, set up, a certain return that they're going to hit. And so it's kind of about, you could kind of think of it in a baseball analogy, not that I'm a big baseball guy, but scoring some runs through, getting wide, hitting some singles and playing small ball as opposed to kind of the old, when I was looking at aggregate acreage and then look and flip that at a huge multiple, swinging for the fences and trying to hit home runs and grand slams, right? So It's just kind of a different mentality on how folks are scoring runs these days.
I mean,
and Catherine, you can see it in our trade volume too.
You can see it in the trade volume as well.
Oh, you can see it. You totally see it in the trade volume. Like we have that. A lot of what Rob was talking about, like 25% of U.S. productions among our clients. But you can see it right now as when oil prices have been going, when they start to go up, when they haven't been going up for a while, immediately hedging. When prices start to trend lower, it dries up. And so we go from our busiest days of the year to our slowest days of the year, like within just a few days. Okay. Sorry to step over you on that.
No, you're totally fine. I'm curious because what y'all are describing is operating within cash flow, which, novel idea, because I'm personally in my paycheck, I can't operate outside of my cash flow, but that changes the game primarily for private equity, who really wanted the quick flip, the 35% minimum. That's the rule of thumb that they had out there. So does private equity die with this new long-term private investor type landscape?
I don't think so.
No.
I mean,
then how do they evolve? How do they evolve?
Again, kind of coming back to that, I think that they evolve by the life cycle of holding onto their assets is going to get longer. Kind of it's being a little more patient, I guess, with letting management team build out and develop an asset, and like I say, kind of really become an operating company, and kind of going that way as opposed to just being flippers. I mean, I think that's really how. I don't think that it's I've heard people talk about that this paradigm shift's going to be the death of private equity, and I don't agree with that. I think that there's a lot of smart money out there and a lot of smart guys in the private equity shops that they know what's going on, and they know that there's alternative ways to they can be dynamic and they can shift with the market.
All right, y'all, I am going to take a minute and tell you about my company, Crude Media, Inc. Crude Media is the creative agency dedicated to building marketing strategies based off of quantifiable data. Now, I know that many of us are looking for our next opportunity, looking to build our existing business unit, or heck, looking to build a personal brand within our industry. Did you know that a well-executed marketing strategy is one of the most crucial elements to successful growth? But here's the dirty little secret. You need a strategy based on data. And it's true. Partnering with the right strategist not only helps you build your footprint and generate new leads, but they can help you identify areas of opportunity within your existing plan so that you can continue to build lines of revenue and exceed your goals. If you are ready to turn your ideas into energy, connect with us at Crude Media Inc. Check us out on Facebook today. It's kind of a sexy headline, though. The death of private equity. They like to blame private equity, or at least some of the old guys like to blame private equity of turning the oil field into a Ponzi scheme. And it's funny, I haven't met anyone who agrees that this is the death of private equity. Everyone says it is, like y'all are saying, a paradigm shift, and they have their own take on that. But it's kind of amusing to me that that is the headline that's circulating and has been circulating for probably 2 years now, I would say.
Yeah, like you say, it's a headline. It's a sexy headline, right? So it's something that people kind of like to beat the drum about, but it's just, I mean, it's not what we've seen. Is there going to be as much capital that's going to go out? No, because I think that you've already seen some consolidation within that world, and again, it just comes back to consolidating assets under good management teams that have the operational efficiencies and capacity to do so. But so I don't think you're going to see as much, active investment, and you haven't seen that, right? I mean, that's long. I'm pretty much for our entire existence, that's been an area of new business for us that has been pretty constant. Is when people get commitments from the private equity world to go out and find an asset, those guys are going to have a hedging need, whether that be, largely private equity wants them to hedge, some of their production as they make acquisitions. So we track that very closely. And I mean, you just see the commitments. It's not to say that it's completely dried up, but compare it to the level of commitments that were coming out 5 years ago, 3 years ago. I mean, it looks a lot different now. So it's again, being patient and kind of slowing down.
Off the bat, quite frankly. I mean, you should be hedging right off the bat. And for the new money that's out there, and I know I say new money, but what I mean is the private investor who's looking to capitalize on the fluctuating landscape, the average Joe, if you will, don't invest in a team who doesn't know what the word hedging means.
I mean, we're always proponents. We think anybody, as soon as you got line of sight on an asset, you should be talking to us. And I'm like laughing about that a little bit, but we do think that that's the truth. And it's something that we've seen. One thing that I've been excited about here recently, talking about, we've seen a slowdown of some of the private equity commitments, but I will say, again, that kind of go hand in hand with that, or had historically gone hand in hand with that, are asset level transactions. And I mean, kind of getting maybe leading to the age of consolidation. We saw a lot of that, and we've seen of that, in just the corporate M&A and some of that shaken out that just frankly had to happen. But what you weren't really seeing was the asset level transactions in the M&A markets. And I came from that side prior to Aegis, and I have a lot of friends that are still in that side of the business, and keeping up with them. Those guys last year was slow. It was slow going for them. And, that's not to say there weren't a lot of deals out on the market, but it was just bid-ask spreads were wide, and with volatility, it seemed like, deals weren't getting done. And over the last 3 to 4 months, since the beginning of the year, and maybe dating back even to the end of last year, we've started seeing some new business coming in from deals, and from acquisitions, asset level transactions, not these big corporate M&A deals. And I do think that that's exciting, because getting back to kind of what we were talking about earlier, there is dry powder out there. There still is capital that they're looking to go out and deploy. And I just think that it's an exciting time that you're starting to see, hopefully fingers crossed that it doesn't, tighten back up a loosening of the A&D markets at those asset level deals.
So I got to ask, just because, I like my gaslighting here. No pun intended. We have seen recently the Great Texas Freeze. Now, I remember from back when I was a little girl, we had a number of these freezes, and it wasn't anything new across the South. But I guess all of the new 1990s and older or younger have this was their first big freeze and it affected the windmills. So what do y'all do in tracking the alternative spectrum and how that is fluctuating throughout the markets, here and abroad?
Yeah, we watch it really closely. I mean, and when we said 2022 earlier, I could have just as easily said, the continued proliferation of renewable energy. And this year was actually a really big one for that. There was, I can't remember exact numbers, but I think it was around 15 gigawatts of new renewables capacity that went in at the end of 2020. And to give you an idea of how much that is, that could be close to 2 BCF a day of natural gas demand displaced if it all went to natural gas. Now, it doesn't happen every day. On average, it's probably closer to 1 BCF a day. But some of the weakness that you've seen in the gas market so far in 2021 has definitely been the result of just the slow bleeding of natural gas demand into the renewable sector. And you can look at, there's a few places if you want to look, you could probably go find it on your own if you wanted to. One is ERCOT. So that's the famous operator in Texas
that
froze.
name a few times here recently.
Yeah, and they do a
freeze.
good job of publishing data. Yeah, and so you can go and look at what the wind generation inside of ERCOT has been, and it's been a step change since December. And then you could also go look. I'd be happy to provide the links after for anybody who's interested, but you can go look nationwide and you can see it's been up too. And so that's going to continue. And as far as what happened in February, there was two different things that went on, and I'm sure everybody's formed their opinion by now, but one was the turbines freezing. But the other is what's happened, the difference between now and in the 90s is that there is so much natural gas production right here in Texas that is not accustomed to having cold weather like that. It just doesn't happen very often. And so we had this double whammy where, the natural gas production came off at the same time that our power generation capacity came off. And it wasn't just those two sources of energy either. It's just widespread.
Interesting. So it's kind of funny. You see the argument between the traditional forms of energy and what we like to call alternative energy, and the narrative is so split based off of your political stance, not what actually is happening across the market.
Yeah.
So I like to just call it all energy because we're so intertwined and we have been for decades. But you're seeing an uptick in the adoption, but to your point, it's not a constant. So is there a point where alternatives take over 30% of the grid? Because it seems like that's their magic number, or has been for a while.
It's been growing steadily, and you can look in the past, and that's probably outside the scope of my knowledge, but you've got federal subsidy helping with the introduction, especially wind in Texas and elsewhere. The EIA had put out some analysis, going back to last year, even when gas prices were cheaper, saying that natural gas demand in the power sector had peaked out. Like it was going to be all downhill from here. And that was a really interesting thought because, you wouldn't expect that population growth is going to suddenly die out, or our need for electricity is going to die out. It was renewables supplanting natural gas fire generation. So yeah, I think it's going to be an ongoing issue. And at some point we'll need to, if we're going to keep production growing, we'll need to export more. And at some point, the entire world will be somewhat saturated with natural gas. We'll have to solve that. But between now and then, let's just hope for continued growth in demand.
There you go.
I love demand. It makes my job a little easier.
Demand is great.
Demand is a wonderful thing.
So as we are wrapping up, because I know I've picked your brains pretty thoroughly here today, but is there anything that's got y'all's attention individually? What is your kind of pulsing peripheral that is keeping your attention in terms of either the energy markets, what the average consumer should be aware of, just honestly anything?
Yep. Hey, Rob, let me go first. So my number one.
Me first. I see how it is.
My number one is what should general people who are paying attention to commodity markets, what should you pay attention to? And it's pretty much every consumable. So you can see you could see whether it's aluminum, copper, steel, oil. I think natural gas is going to come later. You could just see this this buying frenzy going on worldwide, recovery of the demand for these materials, and nobody is immune from it. The prices of lumber are going up to where I think I saw some estimates that the average house costs $16,000 more to build now because lumber prices are going up. And this is it's something that's going to affect everybody. It's a contributor to the pure definition of inflation, which is just general rising of prices. And it should be concerning. So if you're in manufacturing, it's especially becoming a difficult problem, because manufacturers often are buying some commodities and selling some commodities at the same time, and sometimes carrying inventory, and during a time when prices are highly volatile. And so I think like being able to measure your risk across an enterprise, all commodity risk is emerging as should be a huge focus in manufacturing.
Can I hedge my bank account with all of this federal wealth distribution?
We could probably come up with a plan.
A synthetic hedge or
You
something.
said the magic word, inflation, and I was like, oh yeah, the thing I'm supposed to be worried about. Rob,
and we didn't even talk about interest rates, but I imagine Rob has something to say about it.
I think that's going to be a part 2 to this, now that you mentioned. Thanks for volunteering. Rob, what is your pulse on industry?
Yeah, I mean, I'll bring it back to something that I kind of touched on earlier, and more specific to the energy and really the E&P space is just, watching kind of some of the folks have kind of been talking so much, not necessarily the death of the growth of the industry, but just the pace of growth in the industry as far as kind of new entrants and what's going on, and capital on the sideline, and how long it's going to take for those guys to start deploying capital and getting active again on that front. And as I mentioned earlier, we're starting to see an uptick in that, which I do think is exciting. I just, some of these things have gotten stale, and some of that's a byproduct of corporate consolidation and corporate M&A. That there's stepchild assets, things that, those guys want to concentrate more on one footprint, and maybe they've got a few different basins where they've got assets, and now's the time for them to start shedding some of that off at asset level transactions and breathing some new life into some of those assets with new management teams coming in. And, you've seen that with some big deal announcements here over the last couple of weeks. And, I'm excited about that, partially just because I'm excited about what we can do for those guys and helping them mitigate those risks around that. We've done some pretty big tranches of some hedges around a couple of big deals that were announced over the last couple of weeks. And so I'm just excited about the A&D markets loosening up finally.
Yeah. So how do the new investors, the new teams, the existing teams who have made it through this, this turmoil, let's call it that, and are looking to sort of re-steady their foundation, how do they get in touch with you guys? How can they start engaging with Aegis in order to protect themselves for our next fluctuation, our next pivot?
Our next pivot. Yeah, I mean, love to talk with anybody that may have some needs out there. Aegis-hedging.com. You can feel free to go there, check out the site, and there's some ways to get in touch with us there. Or find Matt, find myself. We're on LinkedIn. We're always happy to talk with anybody, even if it's just gonna talking through thoughts on the market and where we may be able to help. So love to talk with anybody that may have some needs.
And I will be sure to link y'all's LinkedIn profiles in the show notes below, so that if someone is interested in contacting you directly, either from something you've said that could totally incriminate you in this podcast episode or otherwise. But guys, thank you so much.
Absolutely. Thanks for having us back. It's always fun. And, the world looks a lot different than when we talked last time. And I'm sure it will again the next time, hopefully the next time you have us back.
Yes.
I don't know. After this, Catherine may not want to have us back. I'm surprised with where things went after the last one, that she's like, yeah, come back. It's like a world went to hell after you guys were in here. So.
It's always fun because you have some pretty good insights on what's happening and which way we're going. So I know everyone appreciates it. Matt, thank you so much for your slides as always. It makes it so much easier to follow, to understand, to digest for the average Joe, to those who are deep in industry. But otherwise, you guys, I cannot wait for part 2 of House of Cards. So I hope you guys have a great rest of your day, but thank you so much.
Thank you. It's a
Our
pleasure.
pleasure. Yeah.